Hello, everyone. I'm Mike,
And I'm Matt.
and this is Mind Your Own Business with Mike and Matt. Our theme today is developing an exit strategy to sell your business, and we have two expert guests to talk about that. And we're pleased to say that we are broadcasting live this afternoon on Mind Your Own Business with Mike and Matt and Voice of Reason Consulting Facebook pages, as well as Video Socials YouTube channel. And as we've said in the past, our plan is to interview a business owner, entrepreneur, and yes, even business consultant for each broadcast. We'll be asking all our guests questions that we hope will be helpful to you, our viewers and listeners who want to be inspired, who want to learn how to be better business owners and entrepreneurs. Our goal is to leave you with at least one good business nugget each time. So today, we have the pleasure of interviewing Rai Archibold and Cory Martin from the Schwartz Heslin Group, a boutique investment banking and strategic advisory services firm that's been operating since 1985, and it's been designed to meet the specific needs of middle market companies. Today, Rai Archibold is managing director, bringing over 25 years of experience, having been involved with public offerings and M&A transactions. And Rai is also a good friend, and we've worked together on projects in the past.
And Cory Martin is also managing director of the company and currently leads the valuation services division of the Schwartz Heslin Group. Cory specializes in providing financial analysis and business valuations to privately held companies, assisting in mergers and acquisition.
Well, welcome, gentlemen. Welcome, Rai. Welcome, Cory. And as you know, our theme today is developing an exit strategy to sell your business. We've heard that a business owner should be planning for their exit strategy the very first day they start the business. So we're going to talk to you guys and find out if that's true. Now, since this is the Mike and Matt show, Rai and Cory will be tag teaming you with our questions. So Matt, how about asking the first few questions?
Sure. So Rai, when should a business owner really start thinking about their exit options?
Well, first, I want to thank you, Matt and Mike, for having us on here. We're, very pleased to be part of this, and hopefully, we impart some wisdom with your clients and your viewers. Mike kind of hit it on the head. When you start your business, you ought to be thinking about what your ultimate exit is. Unfortunately, most business owners don't proceed that way. What I think often gets lost in the noise is because they're so focused on the business, they don't really appreciate the time and the planning that goes into an exit. So, not to be pithy, but it's, I would suggest that usually you probably need a 2 to 5 year window, depending on your business, depending on your organization and the sophistication and complexity of your business, to start planning.
So Rai, what do you think the three most important items that a business owner should be considering for getting ready or transition out of their business?
Well, there's a couple things. The first one that often comes to mind, particularly when we're dealing with potential buyers, is the state of the financials. Your financials need to be in very strong organization. Also, to the extent that you are running the business as a lifestyle business, to the extent that you can start to take some of those expenses out of the business, with the idea of presenting what a true cash flow of the business is outside of other personal expenses you may be running through. But the first thing really is getting your financial house in order. The second, and often this is a challenge for business owners, is that they are often the face of the enterprise. And the next thing that they ought to be thinking about is the infrastructure underneath them. What's the sales and marketing, staffing, and strategy there? Do they have somebody in place? Do they have the finance function in place? Do they have an HR function? And all these things need to be taken into account with the idea that you want to present that you're selling a business and not yourself. So those are the two things. And then the third thing I would offer is that you really need to have a sense as to how do you position yourself in the market. And in some ways, this is really how you're running your business and should be reflected in that. But you want to be able to demonstrate that you have a defensible market position, a unique market position, something that makes your firm stand out. And that probably would come through in the other two items I suggested, the financials as well as the management structure. But that's something that I think you need to bear in mind, is that you want to present that you're selling a business and not yourself.
So Ray, we talk about that. That's called the value proposition.
Yes,
Agree?
that really is. Yes. And we try to work with owners in developing what the value proposition is. Our process, for example, we go through a very lengthy process trying to develop that for the idea that when we approach a prospective buyer, it's very clear why this opportunity should be attractive and important to the buyer.
It's really great information, Ray. That really is terrific. So Cory, now you're the valuation guy, right? So how does a business owner determine what their business is worth? Is it just whatever they think? Is it, whatever the seller wants to buy the business at? And when do you think is the optimum time to sell one's business?
Yep. Well, Mike, thanks for having us. We really appreciate the opportunity. It's really no different from real estate, right? It's really what the market dictates at the end of the day. So, for example, if I'm in a neighborhood that supports $200,000 homes and I think I'm going to get $500,000, that's just not realistic. So it really isn't what a business owner thinks they're worth. It's what the market dictates. To answer your question on approach of value, it is very technical. I'm a certified valuation analyst through the National Association of CVAs. And we really look at it from three perspectives. You want to look at, it's called the asset approach. It's really looking at the book value or the equity of a business. Now, if, we're looking at a going concern operation, we generally discount the book value. But it is, in a liquidation sense, it is a value point that we would look at. The other approach is to look at what's going on in the market. The market approach looks at two different things. It looks at public companies because, they're publicly available information. So you can determine what the market cap of those companies are compared to their revenue and compared to what we call EBITDA, which is free cash flow. It's your earnings before interest, taxes, depreciation, and amortization, and really represents what the cash flow of the business is. So in that approach, you're really looking at the market cap to revenue multiple, the market cap to EBITDA multiple. That becomes a proxy for value. Now, granted, many of the businesses that we're valuing on the private side are much smaller, probably much different profile than those public companies. So again, it just becomes a data point for us to look at, but in many cases isn't really something we put a lot of stock in, if you will.
So, Cory, once an owner has an idea of the business value, what are some of the things they can do to improve the value of their business?
Yeah, so I'll finish talking about other proxies of value. You got the market transactions, which are actual transactions of companies similar to the company we're valuing. That becomes a pretty good proxy. If you can find businesses that are selling, what are they selling for? That becomes a proxy. Probably the most relevant, Mike, is looking at cash flow. What is the future value of a business's cash flow? And that's really what investors want to know. All of the market comps, market proxies are great, and they are, from a technical perspective, important, but it's really looking at what the value of your cash flows are.
So I want to just it's very technical, and I'm even having trouble following some of this. But you're the numbers guy, so I would expect this from you, not from Ray, but no. but actually, what I hear two things: the market dictates. You look at public companies as a data point, and the most important thing I heard you say is the cash flow future value.
That's correct.
So now, coming back to that question that I interrupted you with before, once the business owner has an idea of what his business is worth or her business, what are some of the things they can do to improve the value of their business?
Yep, great question. So as part of evaluation, we really look at benchmarking a company to its peers. So that can help you to normalize things in your operations, whether you need to find margin improvement, operational improvement. Some of the things that are very common are customer concentration risk. A client may be growing at a substantial pace, but if you're dealing with one or two major customers, that really has an impact on your valuation. Other areas, which Ray alluded to before, are processes, controls. In many cases, an owner is also the operator without a lot of management depth. So if you're looking to sell a business, a buyer's going to look at that, and that also will depress value. So it's really upon a business owner to start thinking about management depth, customer diversification, operational and marginal improvements. I think those are kind of the main areas of improving valuation.
That's pretty good. That's terrific. So, in other words, every part of your business, not just
That's right.
just
That's right. Yep.
Matt, you're going to ask Cory.
So, Ray, we've heard Cory's answer to the question. I'd like to hear what your thoughts are. When do you think is the optimum time for an owner to be able to sell his business?
Well, that's interesting because we're often asked, like, when is the right time? Because people, they look at what's going on in the financial markets, what's happening in, geopolitical concerns, and, should I be selling my business now or should I wait? What I will share is that for most of our clients, there's usually a microeconomic factor that drives that process, something that's endemic to their personal life, or what's going on with the business. So generally speaking, the optimum time to sell the business, it would be when you believe as an owner that it's time for you perhaps to transition out. This may be because you've run the business for 10, 15 years and you want to do something new. It may be a function of age, and often that's the catalyst is, the owner's getting older and is thinking it's probably time to transition. But we try to dissuade people from trying to time the market with the idea of looking at what's going on in financial markets, because as Cory pointed out, the most important factor that drives the value of your business is your cash flows. And as long as those cash flows are sustainable, predictable, and strong, that's going to be the primary metric for value. And that largely counters what you will hear, particularly in the marketplace, the middle market and lower middle market, where most of our clients are. A lot of what's going on in the macro market tends to be noise. Now, that aside, you have issues, for example, like the COVID environment we've gone through. That threw a lot of businesses a curveball. And so you had a lot of companies who may have been thinking about exits, postponing that. But that aside, generally, it's really a catalyst that's happening with the owner themselves. Second thing that often happens, and we see this quite a bit, is they may be approached by a strategic competitor or another company in the space who says, hey, I want to buy your business. And we will often then get a call from those clients or their other advisors, like their attorneys, saying, hey, they've been approached, what should they do? And usually the first thing we do, and Cory would step in, is that we do evaluation, see if that person, the offer that was made is a reasonable offer. And oftentimes, even if it is a reasonable offer, we would suggest that they run some type of process to engage other strategic buyers with the idea of trying to create an auction. But to answer your question directly, Matt, often the optimum time is really a function of what's going on in the life and objectives and desires of the owner.
Gotcha.
Got it.
That's a great explanation. Thank you, Ray. So, Cory, supposing a larger company, or even a competitor approaches a business owner with an offer to buy their business, and they're not interested at that time, and yet they would like to consider that offer at some time in the future when they themselves are larger and believe that they're worth more. So how do you suggest they continue to leverage that connection?
Yep. So my first piece of advice for that situation, Mike, would be to really consider the fact that there's a bird in hand, if you will. There is an offer on the table, so it may be dismissive just to ignore it altogether, because an offer to sell doesn't mean you can, necessarily have to sell 100% of your business. There may be an opportunity to sell a minority stake in the business. There's a lot of ways a deal can be structured. So my first piece of advice would be that let's at least entertain it. Now, to answer your question directly, it's all about relationships, maintaining a relationship with that party, frequent check-ins, just constant communication. With that said, I would caution you, if it is a competitor, be careful that they're not trying to poach and obtain some kind of information. So be very selective about what you provide to that person or that potential buyer.
I was going to ask you this, Cory. How does, in a situation like this, how does a business protect itself? And just exactly what you said. Supposing it is a competitor that is going fishing, and it is very attractive to the business that wants to possibly be acquired. How do they protect themselves from, giving away their secrets?
Yep. First and foremost, confidentiality agreements. But even then, I'd be incredibly selective about what type of financial information or customer or business information that you provide. I see Ray and I are working on a transaction right now. We're 2 weeks out from closing, and we still have not disclosed customer names because we want to make sure that this deal has a 99.9% probability of going through. So, that's really our job as investment bankers, is quarterbacking that process and making sure that the information flow is divulged at the appropriate time. But in that scenario, especially if it's a competitor, be very careful about the level of information that you provide.
Okay. Matt, I think you've got some questions for Ray.
Actually, for both. So this is for Ray and Cory. So who should a business owner have on his team or his or her team when they're seriously considering selling the business and getting their business ready for an exit?
Well, I'll take a first cut and then Cory can fill in. But generally speaking, it's sort of the cast of characters that you've been working with all along. So your attorney, your accountant, your commercial banker often. However, what I would counsel, particularly as it pertains to your attorney, is that while they may have been representing you in your business dealings for some time, you want to make sure that they have transaction experience. And that is important because, as Cory alluded to, you're going through a lot of documents, particularly the purchase sale agreement tends to be a very complex document. And an attorney with transaction experience will have an idea of what reps and warranties, which are basically the addendum to the agreement that stipulates what you're saying about your business that's true. Your attorney is going to know what's market and will be able to guide you in terms of how to negotiate position. Similar with your accountant, that they also have some transaction experience, but more importantly that they're in a position to be responsive to the diligence questions of the buyers as it pertains to your financials. So your attorney and your accountant are probably two key players in the transaction. And then your other trusted advisors, such as you two, your commercial banker, perhaps, and to the extent that there are issues related to what's going on in your balance sheet. And I would strongly recommend, and somewhat self-serving, that you have an investment.
Not self-serving at all, Ray. That's why I'm here. Come on, let's hear it.
Again, the idea of having an investment banker working with you, as much as similar to what I was saying about the attorney, we understand what is the market. We understand, particularly in terms of determining value and positioning, as well as terms and conditions that are reasonable in the market versus unreasonable. So those are really the key players that you should have on a team. Cory, if you want to add anything more to that.
Yeah, that's great. The only thing I would add is, in advance of a transaction, is to have a wealth advisor so that you could do pre-sale planning. And a lot of that could factor into how the transaction is structured from a tax perspective. If you're looking to minimize taxes, you may start to plan about where you're domiciled, right? To move to a state that has lower or no taxes. So it's never too early to get your wealth advisor involved, because that will help determine the best course of action and the best structure in a deal.
Yeah, that's great advice. That's terrific. So, I've been taking some notes, guys. This is like going to school. You guys have just an enormous number of nuggets here. But I'm gonna. I guess what we'll do is I'll ask you guys what are the golden business nugget that you think would help people listening and watching this podcast, and I'll hold you guys to say one each, and then I'm going to read you back some of my notes that I think will cover a lot of the good things you said. So, Ray, one thing.
Well, so Cory mentioned this earlier, particularly with middle market and lower middle market companies. Often there's concentrations among clients, among your customer base. And as an owner, you may not think of it as a risk. I have a great relationship with them. I've done business with them for 25 years. From the buyer's perspective, that is a substantial risk. So what we would encourage is, to the extent that you have a concentrated customer base, that you start working toward diversifying that customer base.
Very good. Cory.
So my piece of advice would be, the minute you open the door to your new business, look at it from the lens of a buyer. If you were going to buy that business, what would you want to see in order to improve value? So that'll help you all along so that you're not scrambling 12 months before you want to sell to do things that'll help improve your value. Just look at it from the lens of a buyer.
Wow.
Good point.
Wow, that's great. So I'm gonna come back to those things, but here's some of the notes that I took. Ray, you talked, the 3 items in preparation for selling your business was get your financial house in order. You also said that you need to realize that you were selling a business, not yourself. So that would go to infrastructure and team, et cetera. You also said that your value proposition had to show your differentiation, had to show your uniqueness, and different from, I guess, from your madding crowd. And Cory, when we asked you about value, you talked about the market is a significant factor in dictating the value, but you also talked about that cash flow and the future value, the stability and predictability of that cash flow was critical. How am I doing so far?
Very good. You get an A for today.
Oh, I'm not finished yet.
Sounds like you're ready for the quiz.
I might get an A+ here. So I think when we talked about customer diversification was something that you said, that one golden nugget. And of course, getting your processes, your controls of the business management. And then when we talked about when is the right time, I think this was really fascinating. And was that the right time is when the business owner believes it is the right time to transition. It could be age, it could be many different factors, but I think that that's really important. And then, of course, when I asked Cory about, if somebody makes you an offer and you want to wait, I like what you said about a bird in hand, and but you would maintain the relationship, but be as careful as you could be in terms of what you disclose.
Yep.
And then I think the last thing that I caught was who should be on your team. You guys mentioned the accountant, the banker, and a transactional attorney, but you also said an investment banker, which the key there was demonstrating the value, the positioning, and the terms and conditions, right? And then lastly, Michael Korn, a good friend of ours, would say he's happy to hear we say a wealth advisor, right, Matt?
Yep. So, Michael, do we have a minute or two?
We have plenty of time, Matt. Let's keep
all right.
going.
So I'm curious, both from Ray and Cory, do you find owners are reluctant to sell their business when they're on the upswing and that maybe wait too long?
Go ahead.
I'll make a comment. There are times when, yes, if they're seeing very strong business momentum, particularly if, they're, seeing strong cash flows, there may be a hesitancy to sell. And so, conversely, when things are difficult, they may be, tired or bruised and decide this may be a time to exit. Ideally, when your business is thriving, to the extent that other things in your life are in alignment, that it's a good time for you to exit. If your business is thriving, that's probably the best time to start considering this, subject to the other factors that we talked about. With the idea, again, that, it's easier to sell a business that's seen, strong growth and strong cash flows rather than one that has had a couple down years where you find yourself trying to explain away why there've been these down years.
Right.
Yep.
Good point. Cory?
I would agree. Yeah. The only thing, so we've been involved in transactions where the company has done so well during the process that the goalposts keep getting moved. So yeah. we went to market with a company a few years ago, and it took us over 12 months because
close to 18 months.
About 18 months, because as diligence was being done, the numbers were so substantial that Ray and I kept going back saying, you gotta increase the value. And ultimately, we squeeze probably another 15 to 20%, if not more, out of that transaction from the initial offer. So,
Right.
With the right advisors and the right team, you can help continue the negotiations to get to a point where the value is improved.
That's a great point, Cory. Thanks.
That is a great point. Well, gentlemen, I want to thank you for coming on board and letting us grill you, and really appreciate it. And love for you to say some few words if you like.
Cory?
No, this was a great opportunity, and we appreciate Matt, Mike allowing us this opportunity, and hopefully it was helpful to your audience.
Yeah. Likewise, I would echo that. We appreciate the opportunity, and obviously with Mike, we've enjoyed working with you and Matt for a long time, and look forward to continuing that relationship.
Yeah, we also feel that way too. So I want to say to our audience, we hope that you enjoyed this podcast. You can subscribe to Mind Your Own Business with Mike and Matt. We have a YouTube channel and we also have a Facebook page. We also have a Voice of Reason Consulting Facebook page. You can see our podcast there, and then you can also see it on videosocials.net. And of course, on our LinkedIn posts. And by the way, you can find Rai Archibold and Cory Martin as well on LinkedIn, and I'm sure they're going to be posting this. So look for them, the Schwartz Heslin Group, which is a terrific group. And I've known Bob Schwartz for a number of years, and of course, Rai and Cory as well. So I'm Mike.
I'm Matt.
And together we are the Voices of Reason. And this has been another Mind Your Own Business podcast with Mike and Matt.
Folks, stay positive, test negative, and thanks for watching. See you all soon.
Bye-bye.
Thank you.
Bye. Bye.